My son Mark was 27 years of age. It was 11 years ago that he passed. He was riding his motorcycle, which was one of his passions in life. I get a phone call from the hospital saying that Mark had been in an accident and the impact was fatal. Mark defined his life by what he loved the most, and those were his friends and his passions. And his passions grew from sports, because they were always involved in sports from the time that they were 4 and 5 years of age.
Just a great guy, just a passion for life, didn't really fit into the academic world and things like that, but just awesome guy.
What was important for me in particular as a mother, as all mothers and fathers who lose their children, I think one of the biggest worries was that they're going to be forgotten. So I wanted Mark's memory to go on forever.
So we started what is now called the Now I Can Children's Fund. And we started it after my brother passed away, and many other people in our family have passed away as well, as a way to maybe give back to the community.
Without the Burlington Foundation, we wouldn't have this fund.
I think the importance of playing giving is different for each person. For me personally, I look at it as, when I'm gone. I don't have any children. My mom's the last person living in my family. So for me, my friends are my life, and the foundation is my life. So for me personally, what I wanted to do was leave the bulk of my estate to the Now I Can Children's Fund, administered by the Burlington Foundation. The
Burlington Foundation has been tremendously helpful for Dan and I. They meet with us on a fairly regular basis and help us identify those kids that are in the most need, that fit with the mandate of our fund, which is to help at-risk children, inspire them, motivate them, and hopefully change their attitude towards life. I think that Mark would be very, very proud.
I think Mark would say something funny like, "Bro, you should have bought me a truck and you should have bought me a dirt bike with this money."
He had a tremendous sense of humor and always trying to make light of everything.
I think he'd be happy that we were doing something in his honor, something that his friends and family will always, that we can all contribute to make a bigger difference, and to know that we never forgot him would be, I don't know why I'm getting emotional, it's been 10 years, but to know we never forgot him.
Mulholland, CEO of the Burlington Foundation. I'd like to thank you all for being here with us today in celebration of National Philanthropy Day. I'd also like to thank Simpson Weigel Law for generously sponsoring today's event, and Yellow Robot for their event support. There are many reasons why individuals, families, and corporations decide to leave a legacy. And those are very personal reasons. And again, we'll get to more of that as we get into the content of our speakers. This webinar would not be possible without the collective experience and passion of our two speakers. Burlington Foundation board member, Tim Cesnik. Tim is the co-founder and CEO of Our Family Office, Inc. And Mark Helper, founder and president of wealthinsurance.com, Inc., who has become a very dear friend of the foundation as well. But before we pass the virtual podium over to our speakers, I would like to introduce a good friend of the foundation, Rick Goldring. Rick is principal of Goldring Financial Leadership, Inc., and Rick was the mayor of Burlington from 2010 to 2018. Rick, would you like to step in and say a few words?
Well, thank you very much, Colleen. I'm very pleased to be with everybody today and make a few comments at the beginning of such a great event on National Philanthropy Day. And I think, the vast majority of us are very fortunate and realize we're very fortunate about where we live, whether it be Burlington or Oakville or Hamilton, Niagara, or anywhere in the GTHA or anywhere in Canada for that matter. And one of the things to be grateful for about Canada is that Canada has some of the most generous tax regulations in the world when it comes to charitable giving. Now, while I served as mayor of Burlington, I had the opportunity to see firsthand the impact of so many different organizations in our community, whether it be our faith communities, our not-for-profit, our charitable sector, service clubs. I mean, the tremendous outpouring of support for so many in our community is significant. And today you have the opportunity to hear from two great presenters who will educate and inspire you on how you can be brilliant in your own personal approach to philanthropy and maximize impact while minimizing tax. And on a personal level, I'm very grateful to live where I do in Burlington. I've lived in Burlington my whole life. Grateful for my family, grateful for opportunities, past, present, and future. Grateful for having served as Mayor of Burlington for 8 years. And in that spirit today, I'm going to share one approach of brilliant philanthropy that my wife, Cheryl, and I are in the process of setting up. We're in the process of donating a joint life and last to die life insurance policy to the foundation. And once it's set up, we will write a check to the foundation for the value of the premium. And the premium is around $3,000. And every year we will donate $3,000 to the foundation, and the foundation will give us a tax receipt. And as long as one of us is alive, the premiums will continue on. We'll donate that every year. And upon the passing of the second one of us to go, $100,000 will be left to the foundation, and will make an impact in the community according to the terms and conditions as defined by Cheryl and I. And it's an elegantly simple way to take advantage of tax rules and to really leave a legacy in a very simple fashion without encumbering the wealth of your family. Now, to hear about many other ideas around brilliant philanthropy, I throw it over to Tim and Mark.
Thank you so much. Rick, it's great to be here, and especially on National Philanthropy Day, and to be speaking with Tim. And thank you, Rick, for really setting this up and making the introduction to Colleen and the incredible work the Burlington Foundation is doing. Look forward to sharing some great ideas with everybody here today. It's been a busy time the last couple of years with COVID. I think that, for the last 30 years of professional practice, we've been trying to convince people they're going to die one day, and nobody seemed to believe us. And it took a global plague for people to be much more aware of their mortality, but also their incompletions, wills, powers of attorney, structures. And one of those areas is their legacy. People have been donating money, but they haven't actually created a legacy for their family. So Tim and I are going to share with you some great ideas that we use with lots of donors and working with allied professionals and nonprofits like Burlington Foundation to help you maximize your giving and minimize your tax. Now, just going forward, please, whatever you look at today, clearly every situation is unique. Make sure that you speak to your professionals before implementing any of these strategies. Now, we have a new government. It's an old government, actually, and apparently they're going to try to make our lives much easier by introducing a one-page new simplified tax form going forward with one question. How much money did you make? Send it to us. Now, we say that very tongue-in-cheek, but the reality is that there's a lot of change happening for all of us that it's important for you all to know, for your families, and also for the people in your life. And that is, taxes are going to be going up. It's not a question of if, it's a question of when. You're going to see possible taxes on wealth, inheritance, the capital gains tax go up from 50% to 75%, principal residence. That's a lot of tax. So people have to look at how are they going to be dealing with that. The good news is that with planning, you could actually convert a lot of this tax into charity. And most people have not done planning. They've done a lot of investing in building their assets, but they haven't actually crystallized what would be the tax today or down the road, or do they have money to be able to give away to charity? We've also entered into an information age, or I call it a misinformation age. People are going online looking for information to help them, but still every family really needs a more bespoke experience. And you've all heard of Freedom 55. Well, Freedom 55 today is when your youngest child is 55. And that's not a joke. Kids getting out of school, saddled with debt, trying to find jobs during COVID, buying real estate. It's going to be very difficult. So our kids are definitely, charity is going to begin at home. We have to look at that. The good news is with COVID is that people are looking for more meaning in their life. How can they make a difference? How can they go from success to significance? So there's a program that's you're going to hear a lot about. It actually started in September nationally called Willpower through the Canadian Association of Gift Planners. And it's an initiative to try to create $40 billion of new charity in Canada by suggesting to people that they just leave a gift in their will. And just simply by doing that, we feel that there's a tremendous opportunity, and you'll hear about that through retail advertising and online presence, and also through the Burlington Foundation. Now, I started 30 years ago professionally, but my real start in the business was actually in 1974. And that's when my father, of blessed memory, died of a massive heart attack at the age of 50. I was 11. I was the youngest of 4 boys. And my mother, who was 48 at the time, had to go back to support our family. The reason was that my father was a busy engineer, and he had very little savings. There was no will, and there was no life insurance. Fast forward, I worked with some of the most successful business owners and families in Canada, and you'd think they'd have everything all organized. But the reality is they're so busy looking after everything and everyone else that when it comes to themselves, they don't have things organized. So this presentation today is really about getting planning done. And how we do that is through estate planning, it's through tax minimization, and through philanthropy. And people have to look at the big picture when it comes to their planning. This is just an example of things that definitely need your attention. Making sure you have an up-to-date will, you have up-to-date insurance, you've done the planning. But one thing that we always talk about at the end is charitable plan giving. And that's what I want to introduce to you today and give you some strategies to help your family. Most people, they'll build up their assets during their lifetime. At some point, they might stop working, in which case they're going to draw down on some of that money, or hopefully they're great investors and their money continues to grow. But the one thing that they'll find out is that they're going to have, unless they were to invest all their money in a penny stock or start spending frivolously, chances are they're going to have more money when they die than what they have today, which means that they're the custodian or trustee for the next generation, but they don't realize that they're also partnering with the tax department on that, with that money. So with proper planning, you can see is they're never spend money that we can use to preserve our estate for family or to include charity in our plans. And the reason that there's such a grind out there around families' wealth is because of taxes while we're alive and at death. These are just a basket of things where people are taxed at death that people are not even aware of, that the growth in these assets are going to be taxable. And taxes payable at death in Ontario, if you have registered money, which would be RSP, RIFs, or pensions, those could be taxed at over 50%. Any appreciated shares in stocks or investment real estate or in a business, the gains are taxed at 27%. If you have money sitting in a corporation, there's a potential tax there of anywhere between 47 and 70% if it's not properly planned. You have passive income tax and probate tax. All in all, it means that you could have done very well, but you're not worth as much as you think. And I just met with an 80-year-old woman who had $10 million of net worth. And when we got together, I explained to her that she was only worth $6.5 million. She was not very happy to hear that, but with proper planning, we were able to preserve that for her estate. And really, we all have to realize we all have 3 possible beneficiaries to our estate. You have family, you have the government, and you've got charity. And each of us can pick 2. Which 2 would you pick? Most people would say family and charity. Of course, we need money for to maintain all of our social services, but there is a way with proper planning to be remembered for leaving a lot of money to charity as opposed to writing a big check to the tax department. Now, we need taxes in Canada. There's no question. That's what keeps all of the lights on and keeps things going. And we have to pay taxes. But I love this quote from Morgan Stanley, but there's no law that says you have to leave a tip. So that's what we're going to go through today. And what we do is we create something called accidental philanthropists. What does that mean? There are 2 kinds of people out there. There are those who just give to charity because it's part of their DNA. They brought up in it either through religion or through their family. And then there are people who just didn't necessarily have that education. Once those people find out that there's a choice where those taxes go and they can give them to charity, suddenly they become accidental philanthropists. And also the people who are currently giving can now give more at the same amount that they were planning on giving, or be able to give the same amount at less cost. And who are some of those accidental philanthropists? This is just a very big list. Certainly widows, divorcees, and singles, are one incident away from a very large tax disposition because they don't have a spouse to roll everything over to on a tax-free basis. Anybody who's sold or will be selling a business or investment real estate or appreciated securities, that's the year they'll have their biggest tax bill, but it's also the year they can be their most generous and also find ways to get that money back to their family. If you've done an estate freeze or will be doing an estate freeze, Tim is going to be speaking about that. If you have a tax bill this coming April and you have appreciated securities, Tim's going to talk about that as well. Certainly having a foundation at Burlington or a donor advised fund, private or a public foundation, is another way to amplify your giving. If you have an old existing life insurance policy that you no longer need, that's a way for you to benefit charity and save taxes. Or if you have an estate tax bill on death, or you're going to have leaving a gift or bequesting your will, there are ways to do it even better. Simple math. And really, this is talking about people who are at the higher end of the marginal tax rate. But every $2 that you give to charity, you save $1 of tax. And whatever receipts you receive in any given year, you can use those receipts to offset up to 75% of your personal tax payable in April. Any receipts over and above that can be carried forward for up to 5 years. But on death, a receipt can be used to offset 100% of state taxes, including going back the prior year to save taxes then as well. So keep that in mind. And here are just some gifting options that we'll go through: gifting in a will, also known as a bequest, gifting registered assets, gifting appreciated securities, which Tim is going to talk about, and gifting life insurance policies. So one way is just to leave a gift in your will and change your will and include the Burlington Foundation for a specific dollar amount or a specific percentage of your estate. Remember, $2 to charity saves $1 of tax. If you don't want to change your will, then why not just notify your financial institution where you have your RSPs or RIFs, and you can get a multiple beneficiary form and make a certain amount, a dollar amount or a percentage to charity. Why is that? Because in Canada, the RSPs and RIFs are they're kind of like a tax time bomb. And the government is prejudiced against widows, divorcees, and singles because there's not going to be a tax-free rollover to a spouse, which means that if somebody has $2 million in RSPs, their family's only going to be getting $920,000. So first thing you have to realize is your RSP is not worth the full amount. It's worth half of that. And with planning, there are ways for you to actually make sure your family still gets the full amount and charity gets your registered money with planning. And we'll talk about another strategy. If you wanted to give away some of your registered money during your lifetime or all of it, there's another great way to do that to save taxes. We don't have a lot of tax shelters left in Canada. These are kind of the final four. You've got your principal residence, you've got TFSAs, which are minimal. You've got lottery winnings. So don't buy your lottery tickets when you go to the States. They're taxable there. They're tax-free here. And the last thing we have is something called tax-exempt life insurance. Anything else that you invest in, there's somebody from the CRA that you clearly love that has their hand out that wants to benefit or participate in your success. So it's important to understand how these work. And here's just an understanding that not all donations are the same. This is the after-tax cost of a donation where somebody gave $1 million as an example. They gave cash, or they donated appreciated securities at a zero cost base, or they had flow-through shares, or they used life insurance. And here's the cost. Here's the cost as a percentage. If you give cash, it costs about 50 cents for every dollar that you donate. So it's not the most efficient, it's the most inefficient. Or donating shares, 23%. If you can get a flow-through share, depending on what jurisdiction you live in, it could be anywhere from 5 to 15 cents per dollar that you donate. Or the last way is using a life insurance, similar to what Rick talked about at the very beginning. And that would be a way of giving away $1 million. So let's talk about life insurance. First thing is this. People have existing insurance policies that they may have bought years ago that maybe would not move the dial on their estate planning or what their needs are for their family. So if you have a permanent insurance policy, you can actually get an actuarial valuation and donate that policy to charity, save taxes today, and going forward, your premiums will be considered donations and you'll get a charitable receipt for that as well. But you'll be recognized for a very large donation to charity. We just did this for a woman who had a $150,000 policy. It was valued at $87,000, which means she saved over $40,000 of tax, and she's recognized for giving $150,000 to charity, and all done in a very, very efficient way. And in some cases, charities will actually pay for those policies going forward if they're of value. Alternatively, you might want to donate a new policy. So if you know you're going to have $1 million of estate tax, why not buy a $2 million life insurance policy and have the beneficiary of that be your charity? Upon death, $2 million goes to the charity, and it saves the estate $1 million of tax, all for using pennies on the dollars. Or lastly, is just change the beneficiary on your current insurance. Just include a dollar amount or a percentage to the Burlington Foundation. Very simple to do, $2 to charity, saves $1 of tax. And here's just an example of a 60-year-old couple where on the left-hand side, they're putting away $100,000 every year of after-tax money in their company for 15 years, or $1.5 million over 15 years, and they're earning 4% on that. If they went ahead and put that away year 30, so when they're 90, their money hasn't even doubled because of the tax grind. On the right-hand side, the couple's putting away the same $100,000 for 15 years, but now they're using insurance as an umbrella. So they have to buy $2.5 million of insurance. At year 30, you've got $4 million. So we've created almost $2 million more of money. So the kids are still getting the same amount they were planning on, but we've now found $2 million more of money that we could use for charitable purposes. And here's a big secret that most Canadians don't know, most charities don't know. And that is life insurance can be owned and paid for by a private foundation or a donor advised fund, which means if you have a donor advised fund at the Burlington Community Foundation, you could actually use this structure, your donor advised fund, to actually own insurance inside of that. And that can create more transformational amounts of money for future distributions from your family. Other giving strategies, well, you know about the donor advised fund. It's a fantastic and easy way of setting up a named fund for your family using the Burlington Foundation. Or you can have a private foundation, which generally has some setup costs and would require you to put substantially more money away to invest on your own. Flow through shares we talked about. If they're available, it means that if you're already giving money to charity, it's just a way of giving money to charity at the least cost possible. Charitable gift annuities are opportunities where people want to get a return on their money. So you still need income. There's a way of donating money to charity that gives you an income for life. Add a charitable receipt today to save taxes. Charitable remainder trusts. You have an investment that you'd like to donate today, but not actually give it to charity till after you die. You can give the charitable receipt today, and the property would become the ownership of the charity down the road. CPP Philanthropy is one of my favorites, and that is in Canada, when you turn 65, you're entitled to receive CPP. It works out to about, for a couple, 65-year-old couple, it's about $26,000 a year. If you're very wealthy, you get taxed on that, and you reinvest it, and it's taxed again. You could take that $26,000 and acquire about a $1.5 million life insurance policy. If it's owned by your donor advised fund at Burlington Foundation, then the $26,000 is considered a charitable donation. So you pay no taxes on your CPP, but you've now created a $1.5 million future gift. Alternatively, use the CPP, pay the taxes on that, and get the $1.5 million insurance policy and donate that to charity upon your death to save $750,000 of estate taxes. Or the last option is take the CPP, pay the taxes on it, get the $1.5 million insurance policy, and make your children the beneficiary of that, and leave your registered money to charity. So remember that $2 million option that we saw earlier, your kids were only getting $920,000. Now they'd be getting $1.5 million, and $2 million could go to charity without any tax. Amazing. We have something called return of premium life insurance, where you can donate insurance and pay for the premium and get your premiums back upon death to your family. Or something that's very important is something we call policy preserver. There's billions of dollars of term life insurance every year that gets canceled because it becomes too expensive or people don't need it anymore. Those policies can be converted to permanent insurance without any medical evidence at all, and you could get a valuation on that and now donate it to charity. Something that really should be aware of so you don't throw away the baby with the bathwater. Just a couple of case studies, and I'm going to turn this over to Tim shortly, about 5 minutes. So we had got introduced to a family that sold some real estate for $120 million, and they were going to have a $20 million tax bill. And they were introduced to us and they said, can we do something philanthropic? So instead of paying the $20 million, we took $40 million of the 120 and we set up a private foundation. That now mitigated the $20 million of tax and created a $40 million foundation. But still the family was out of pocket that $40 million. So we used life insurance to get the $40 million back into the hands of the family. And we used a financing strategy to do that. So there's a whole bunch of shells that you can move around. Make sure that you're aware of it. If you have an RSP or a RIF that you don't need today, remember $2 million of an RSP is only worth 920. You can actually donate all or part of your RSP or RIF to your donor advised fund. The cost to do that is about 3.5% only. And you now are moving that money in kind to your foundation. And then you could use that money inside the foundation to give away to any registered charity in Canada, or use some of that money to buy insurance inside your foundation to amplify it even more. A lot of people think about insurance as something that only benefits a charity when you die, but in fact, there are ways to benefit a charity while you're alive. And if the charity owns the insurance policy, then the dividends that are produced can actually be distributed tax-free to charity while you're alive. And the cash surrender value, which is almost like a line of credit, can also be accessed by the charity during your lifetime. So it's not only about upon death. And then as far as private share donation strategies, Tim is going to talk about that very shortly. There are four kind of givers out there. Some people want to give, don't put my name anywhere, otherwise I'm not going to give another dollar. And others give because they want to set an example for others to follow on their steed. And then there are those who want to do it because they want to be remembered. They want their name on a building. They want their children to see what they've done. And then the last ones are people who realize being philanthropic is great for business. You know, people want to do business with people who are philanthropic. And here's an example of a couple we worked with who donated $1 million to one of the local hospitals of $1 million insurance policy for them at a cost of about $4,000 a year after tax for 20 years. So imagine that, $80,000 to be able to be recognized for $1 million gift to your favorite charity. It's magic, so it's something to consider. Last thing I want to just say is most of us know who our grandparents are. But if I asked you, do you know the names of your great-grandparents? Most people would not know the names of their great-grandparents. This is actually a picture of my great-grandparents, Aaron and Liba Gross of blessed memory in 1934 in Poland, unfortunately, before they died in the Holocaust. Imagine if on January the 1st, you received an envelope in the mail. Inside was a check for $10,000 from your great-grandfather. You think you'd remember their name? So with proper planning, there are ways to actually create that legacy for your children, even more so for your grandchildren. They say the apple doesn't fall far from the tree. That's when the weather conditions are perfect. But when it's windy, the apple is far from the tree. And if there's a tsunami like there is today, social media, etc., the apple doesn't even know that it came from a tree. So with proper planning, there are ways for us to inculcate our children and our grandchildren with this idea of values and morals and being able to take the success that we've had and actually create significance for our families, all by taking some time to do some planning. And I encourage you to do it clearly while the sun is shining. So next steps, I have something called the 48-hour rule. And that is, if any of this or any of what you hear from Tim inspired you, do something about it within 48 hours. Otherwise, we go back to sleep and it's business as usual. Speak to Colleen at the foundation. She can certainly help you, and we can certainly help you with your family and your professional advisors to do something great. Reach out to me. I'm happy to share with you our tax letter digest and one-pagers that goes ahead and takes case studies of all the things we've spoken about. And please connect with me on LinkedIn. We do a lot of posting on philanthropic strategies and opportunities. And also watch my TED Talk called The New Philanthropy, which will help frame a lot of what we're speaking about. Learn about it. Don't ignore it. There's just too much riding on the line for you and your family and your legacies. And you might want to now just consider maximizing your legacy gift. Here's just a chart showing $1 million gift of a life insurance policy for a single life for one person, healthy non-smoker, and paying premiums for 10 years only. And as you can see, the after net or net after tax on the right-hand side would be the annual cost net after tax in order to be able to do $1 million donation to your donor advised fund or to the charities that you're passionate about. And that is my portion of the presentation. I'd now like to pass it along to Tim Sesnick, who of course will be able to give you some wonderful future ideas. Thank you.
First of all, thank you very much for spending your time here this afternoon with us. Just for your benefit, I am on the board of the Burlington Community Foundation. And so I've really appreciated working with Colleen over the last few years, and just have a real appreciation for what the Burlington Foundation is doing. And I would encourage you to, if you are looking at philanthropy or helping your clients with philanthropy, consider the foundation, because the foundation is a wealth of resources as well for you. What I'm going to do now is I want to share with you what I would call 3 of the best practices of successful families. Successful families, they do from a wealth management or financial perspective that really make a difference in the lives of their families, but also in the lives of the communities around them. So what I want to do is I want to talk to you today about thinking a little bit differently about what you've accumulated, the wealth that you do have. I want to talk to you about what I call the 3 capital realms. I think successful families recognize that there are these 3 capital realms, which I'll talk about in a minute. And then also making a difference in the world. A lot of successful families want to make a difference in the world. So I'm going to talk a bit about that. I'm going to share a couple of ideas that I think could make a big difference for you and your family or your clients. And also I'm going to finish off by talking a little bit about some bonus content or material, just talking about year-end tax planning ideas. As we come up towards the end of the year, there may be some things that you can do to pay less tax for 2021 and going into 2022 as well. So let's just turn our attention now to how we think about wealth. And successful families, I think, view wealth as not being just the financial resources that they have. It's a very important aspect, of course, obviously. But most successful families will think about the wealth that they have as being broader than just that. In fact, 6 types of capital. The first type of capital is spiritual capital, which is the core values of a family. And many successful families take the time to think about what those values are and actually try to take steps to pass those on to future generations. Each generation will have its own core set of values, but a lot of key values, including philanthropy and the desire to give back, are often the kinds of capital that gets passed along to future generations. Children learn from their parents when it comes to being generous. There's also, of course, the financial capital, which we'll talk a bit more about in a minute. That's the financial resources that you have and that your family has. Then we've got human capital, which is the extent to which your family and the members of your family, your children, you are living healthy, physically healthy, mentally healthy, and productive lives. And that's what we call human capital. There's also family capital, which is the extent to which family members are getting along, that they're talking to each other, they're communicating properly. If they're sharing resources, financial resources, they're doing that effectively. So family capital is also a type of capital that families have. Then we've got structural capital, which is what I call the boxes on the page. It's the corporations, it's the trusts, it's the investment accounts, it's the stuff that you're going to be leaving behind when you're no longer here. And that kind of structure, which, by the way, can also include governance. If you're leaving behind enough assets where children will be sharing those assets, how are they going to get along? How do they make decisions together? That's common when it comes to cottages. How do kids share the cottage? And people often assume that can't be done successfully. Well, it can be done successfully, but it takes thinking around that structural capital a little bit. And then lastly, societal capital. That's the extent to which a family thinks about the world around them, the community around them, not just thinking about their family alone, but the world around them and how they impact that world or that community and how they give back. And that's societal capital. So the wealth of a family is broader than just the money. And the successful families will think about each of these and try to pass these along to future generations. So I want to talk now about the financial capital for a minute. So we talked about the 6 types of capital. Let's talk about financial capital. And specifically, we can break down that financial capital into what I would call the 3 capital realms, or three buckets, if you will. You can almost think about every dollar that you own whether it's in real estate or investments, or wherever it is, you can think about each dollar as having a job description to it. And that job description at the highest level is one of three types of jobs. So let's take a look at what I call the three capital realms. And I'm going to show you a picture of a triangle here. And on the bottom layer of this triangle is what I call financial independence capital. This is the money or the capital that is needed for you and your spouse, if you have a spouse, to look after yourselves for the rest of your lives. So if we reduced your assets to one pool of money, how much does that have to be to look after yourself for the rest of your lives? Forget about the children for a second. Let's just talk about you and a spouse if you have a spouse. And that's your financial independence capital. And you can define that amount. That can be figured out in terms of how it's defined in terms of dollar number. But if you've got more than you need to live for the rest of your life, and not everybody does, but for those who do, what do you do with the rest? That brings us to the next layer of the triangle, and that is legacy capital. This is money that's going to go on to the next generation or generations. And how long that lasts depends on a number of factors, including not just how much it is, but how you manage it along the way, how your children step in and manage it or receive it. That's legacy capital. And for some people, and for an increasing number of people, and many of the clients we work with, there's a third layer to this triangle, and that is what we call social capital. So when we look at your money, your financial resources now, there is money there to not only look after yourself and your spouse, not only money to leave to the next generation, but money that people are earmarking or have set aside to give back to society, social capital. Okay, and we can define and protect each of these layers of this triangle. Now, the interesting thing about this triangle is that each of these pools of capital, if you want to think about them as pools of capital, has a different purpose, a different time horizon, and a different liquidity need, and arguably then should be invested differently or managed a little bit differently, taking on less risk at the lower end of the triangle here, where your financial independence is concerned. That's where you take the least risk on. The other types of capital, legacy capital and social capital, are invested in such a way to achieve those objectives. Social capital, for example, often generates income so that it can be on an annual basis, money can be given away. Those are the three types of capital. I want to talk now about making a difference in the world. So when we look at that triangle, we talk about financial independence, legacy. Let's also talk about social capital. That's how to make a difference in the world, the kind of things you can do with your money to maximize what you give and how you do that. Let's take a look at this. So before I jump into some specific ideas, I just want to talk about this social capital and particularly the money. We're talking about the money aspect of giving. And if you think about it, you have a certain amount of income that you earn every year. You've got a certain level of assets that you have available to you. And what are you going to do with that money? Well, some of it you're going to use for personal expenditures. You have to meet the cost of living or whatever that is, groceries, travel, whatever it is. But we do know that some of that money is going to end up in the hands of CRA, the government, and in the coffers of the government's coffers. Now, what's the government going to do with that money? Well, let's just say that they're going to use that for the social good. They're going to use it for the betterment of society. That's the intention. Now, we know that doesn't always happen, and there's a lot of wastage. But the government will direct your tax dollars in some manner to give back to society. That's the intention anyway. Now, wouldn't it be more meaningful if you could bypass this filter that we call the government and give directly to the causes that are most important to you? We call that self-directed giving. Rather than, everyone's going to give one way or another, whether it's self-directed or voluntarily, or whether it's involuntarily through our tax system. But the more meaningful type of gift is the gift that you self-direct and you decide what the money should be used for. And so I want to encourage you if you work with clients to think about social capital this way. It's going to happen. It's just that do you run it through the government's filters first, or do you give directly? By giving directly, the government actually partners with you in your giving. For every dollar you give to a charity, 50 cents of that, or a little bit more than that in many cases, is paid for by the government, because the government gives back donation tax credits or deductions, depending on who's giving and the type of entity that's giving. So when the government gives back those tax dollars, they are effectively partnering with you in the giving process. So social capital is going to happen. I would encourage you to think about it as a voluntary activity. Now, I want to talk for a second before I jump into these ideas I'm talking about. I want to talk about the 7 faces of philanthropy. Very briefly, these are 7 key reasons why people give. And there are more than 7 reasons why people give, but these are probably the 7 most common reasons. And this actually comes from a book by a gentleman by the name of Alan Prince, who had done a lot of research with affluent families in the US and identified why people actually give. And when you understand why you give, it can lead to all kinds of answers about, well, how much, which pocket should I give out of? My personal pocket, my corporation, my family trust, a foundation. Where should you give from? And when should you give away during your lifetime? Should you give away at the time of passing away? And there's no one right answer to these questions, but when you know why you give, it can lead to a bunch of other answers around your giving. So let me talk about what those are, these faces of philanthropy. The first one, the first type of individual that gives are communitarians. These are people who believe that doing good makes sense, and they look to give back to their communities. You've also got people who we would call the devout, who give back for faith reasons. Then you've got people who are investors, who believe that doing good is actually good for business. So let me just pause there, for example. As an example of what I was talking about, if you are an investor and you want to do good because doing good is good for business, which pocket are you going to give out of? Are you going to give out of your business or corporate pocket, or are you going to give out of your personal pocket? Well, you could do either, but many investors will give out of their business pocket or the corporate pocket. And when are they going to give that money? Is it when they pass away? Maybe, but most are giving on an annual basis because they want their business to be recognized annually for making a difference in the community. So that's an example of when you understand the why, it can lead to decisions around how much and when and which pocket you give from. Then there are those who are socialites, where doing good is fun, and they give back. Quite often they give back of their time, but they often give back money as well. Then there are repayers, who believe that doing good in return is important. So an example of this would be an individual who maybe earned all of their profit and their wealth through a particular industry, for example, or a type of sport, a professional athlete. And they feel that giving back to that industry, giving back to that sport is important because that's how they created their success and their wealth. So those are repayers who may want to give back to those industries or those endeavors that help them get to where they are. Then there are altruists who believe that doing good just feels right. It feels like the right thing to do. And then lastly, there are dynasts, where doing good is a family tradition. And like I said earlier, parents often set examples for their children in how to give. And actually, there's no better way than a foundation to teach your children the importance of giving back. And so, for example, if you set up a donor-advised fund at the Burlington Foundation, for example, it provides an opportunity to involve the next generation in some of that giving. You can get together and talk about where you want grants to be made. There's a process you can go through with the family, which really teaches them and shows them how important this is to you. Foundations can be a great way to teach children about good governance, because you can set up, meetings semi-annually to talk about the giving. So good governance, business principles, investment strategy. You can teach them things about this through a foundation. It's almost like a foundation can be good training wheels without showing the kids necessarily everything that you have today in terms of financial resources. You can show them the foundation and get them involved in that at a younger age and start teaching them about some of these important things. So family tradition can be a great way to pass along, an example to the children can be a great way to pass along that giving tradition. Now I want to talk about a couple of ideas, and the specific one I want to talk about first is what we call an insured donation of shares. Now, in this case, we're talking about private company shares. So whether you have clients that have companies, or whether you are an individual that has a holding company or an active business, if you have corporation shares, this idea might be for you. So how does this work? Well, this idea is going to create a structure that will eliminate tax on private company shares at the time of passing away. It's going to provide a very meaningful gift to charity, and it's going to leave a lot more to your heirs at the same time. Now, in setting up this structure, we want to be mindful of trying to keep things as simple as possible, trying to keep the cost of implementation low. But when you see the benefits of this idea, I think you'll find that, for most of our clients, when they see how this works and they see the financial benefits, it's almost a no-brainer to implement this kind of idea. Now, this idea does involve life insurance. I know Mark was talking a bit about life insurance. The reason you're hearing some conversations about life insurance today is because life insurance is a very interesting tool that can create a much larger gift at the time of passing away than just the resources that you're accumulating. All gifts are good, but in this case, you'll see what the insurance can do in this particular case. So let's walk through how this works. So at the time of passing away, a portion of your private company shares, not all of them, but a portion can be donated to charity, ideally to a foundation. Not all charities will be equipped to receive gifts of private company shares, but a foundation can be established to, or can be set up. A public foundation quite often is able to receive these kinds of donations. And a donation tax credit will eliminate tax on the shares upon death. So let's give an example. Let's say we have an individual who owns shares in a holding company. Quite often we might have done an estate freeze here. The value, not getting into the details of an estate freeze today, but this holding company might have gone through an estate freeze, which means that the value of this holding company is now capped from a tax point of view, capped in value. So the tax bill is not getting any bigger after the date of the freeze. When you do a freeze, that's what you accomplish. You cap your tax bill on a particular asset, usually a holding company today. And the future growth of that holding company actually goes on to usually a family trust or to the next generation. You don't have to give up control or give up ownership or use of the assets, but you're passing the future tax bill on the future growth to the next generation. So we may have done a freeze here. That's often the best way to start this. But let's supposing this individual has a holding company. At the time of death, this person is going to donate some of those shares in that corporation to a registered charity. Could be a public foundation, could be the Burlington Foundation, for example. Now, when you make this donation of shares, normally it works best when you're donating about 40% of the shares. And I'll get into the numbers in a second and show you what that can look like. But it wouldn't be all the shares, but probably 40%. The next step here is that life insurance at the time of the second spouse's passing, quite often you'll set this up so that the donation to the foundation comes at the second spouse's death. Because quite often people will leave their private company shares to their spouse, no tax to pay upon that transfer. But when the second spouse passes away, that's when the tax bill can hit. So quite often this is done using a joint life insurance policy on the lives of both spouses. But when that second spouse dies, life insurance will be paid. And if you don't have a spouse, that's fine. We can do it just on your life alone. But when you pass away, or the second spouse passes away, life insurance gets paid into the holding company. Now, what happens from there? Well, from there, don't forget that charity that receives some of your private company shares. What can a charity really do with your private company shares? Not very much. The charity actually would benefit more from having cash. And so what happens in this case is the life insurance gets paid into the company upon your death, and then the company takes all or some of that cash and buys back those shares that the charity owns. Those shares you donated to the charity will now be converted to cash. So the charity ends up with the cash, okay? Now in this process, when the life insurance makes its way into your corporation, it bumps up something called the capital dividend account of your company. The capital dividend account is a very important account on paper in your company because it's the amount of money that the beneficiaries or the owners of the shares can pull out of the company on a tax-free basis. So it's very important to have this capital dividend account, and it can be taken advantage of after you're gone because that capital dividend account is bumped up or increases typically by the amount of the life insurance that it receives. And so that provides this tax-free ability to pull money out of the company tax-free after you're gone. Now, the third step is this. So we want to take advantage of this capital dividend account. So you've passed away, you've left some of your shares to charity. Because you're gone, the life insurance gets paid into your company and the charity gets some of that cash. Well, what are we going to do now with this capital dividend account? Well, we're going to use it up. Now, how do we do that? By redeeming. Your estate will now redeem some of the shares that you own in your holding company. Okay. And when you redeem shares, you're cashing them in effectively. And normally your estate would be taxed on a dividend when it does that. But because of the capital dividend account that's available, that can be a tax-free redemption of shares, a tax-free transaction. So we're really creating this tax-free pipeline. So what happens is your estate redeems these shares and receives a promissory note in exchange. And that promissory note can be paid off at any time in the future with assets that are inside your company, all on a tax-free basis. So we've created this tax-free pipeline out of the company. Now, one more thing that happens when you do this redemption, I won't get into the math behind it, but it creates a capital loss in your estate, which can be used to offset capital gains on your final date of death tax return. So in other words, just to summarize here, what you're doing here is you're making a meaningful donation to charity. This is the summary of the benefits here of this idea. You're making a meaningful donation to charity, and you're saving tax in 3 ways. One, because of the donation tax credit that's created when you pass away. That reduces the tax owing on these private company shares or eliminates it. Secondly, it creates a tax-free pipeline out of your company, the strategy, by that capital dividend account I talked about. And thirdly, it creates this capital loss in your estate that can be used to offset taxes owing on your date of death, other taxes owing on your date of death. Now, let me show you just the math behind this now. This picture shows you the numbers. Take a look sort of on the left-hand side of your screen here. You'll see in this example, we're assuming a company with a value of $2 million. Let's just assume your holding company is worth $2 million. And you buy $1 million of life insurance. Let's just say half the value of your company you've purchased in life insurance. And when you pass away, you're going to donate 40% of your shares to charity. So 40% of your shares is actually an $800,000 gift. 40% of $2 million. That's the value of your company. That's a big gift, but let's take a look at the results of this. So in the first column where you see number 1 there, scenario number 1, it's the do nothing scenario. In that case, in Ontario this year, if you pass away with a $2 million holding company, you're going to be left with about $1.4 million, almost $1.5 million to the heirs, and CRA is going to get the other $535,000, okay? Now, supposing you like this donation concept we talked about, what we can do here is we can donate some of those shares to charity instead. That's the scenario number 2 in the middle column. In that column, you might say, but I don't like the insurance part of it, so let me just donate my shares instead. Well, in that case, you're going to eliminate a lot of tax. You see, CRA only gets a little bit now. The charity gets $800,000 because you've donated 40% of your shares, and your heirs get the balance, $1 million or so. The problem is the charity is getting private company shares and can't really do much with those shares. So let's move over to the third column now, where we're donating shares with the life insurance as well. It involves the purchase of the life insurance. In this case, the charity still gets $800,000 in cash this time. Your heirs receive value of almost $2.5 million, which is significantly more than what you would have received. They would have received without the strategy. And CRA picks up the tab, pays the difference in terms of tax savings. And the tax savings come in those ways at the bottom of this page. You can see about $1 million in tax savings from the donation of the shares, from the capital dividend account, and from that capital loss we talked about. Just to wrap this up, let me just share with you the net benefit. The net benefit overall is about $1.8 million of additional value here because of this strategy. And that value is split between the family and the charity. You can see it here that over on the right-hand side, the family gets $1 million of that value. The foundation gets $800,000 of that value. So really for every dollar of life insurance you're paying for, there's about $4 of benefit that goes to the family, a little bit over that, and about $2.70 goes to the foundation of a total benefits of about $7 actually. That's it for the insured donation of shares concept. And I promise that's as technical as I'm going to get. So I want to talk about one more idea and then we'll wrap this up. Donating securities to charity. Mark talked about this briefly. The question is, do you or do your clients own any stocks, bonds, or mutual funds that have appreciated in value? If so, you can make a gift of those investments to a charity. And back in 2006, the government changed the tax rules to eliminate capital gains on the donation of publicly traded securities. So now, what about a situation where you want to sell a particular investment and you want to reinvest those proceeds in something else? So you've got something that's gone up in value, you want to sell it, you want to reinvest the proceeds. You could donate some, but maybe you don't want to donate the full amount to charity. Well, you know what? A partial donation can still eliminate all the tax on that investment. Okay, so let me show you what I'm talking about here. Let's take an individual. Her name is Sarah. She owns shares in a publicly traded company. Let's call it XYZ Corporation. Let's say the shares are worth $100,000 and they had cost her $50,000. So they've doubled in value. Now she wants to sell her shares in this publicly traded company. And she wants to donate some of that value to charity. Well, if she sells the shares, she's going to trigger a tax bill of a little over $13,000 in Ontario this year at a marginal tax rate of 53%. So that's a pretty big tax bill on $100,000 of stock. She's giving away almost a little more than $13,000 in tax. Her cash in hand after the taxes is $86,600. Okay, that's if she doesn't make any gift. But what if she decides to make a gift? Let's take a look at this idea. She can donate $20,000 worth of XYZ shares to charity. So she's donating the securities themselves now to the charity. And then she sells the balance and keeps the $80,000 of that balance that she sells off. Okay. The result of this is going to be $10,000 in taxes on the $80,000 worth of shares that she sold. Okay. But there's no tax to pay on the shares that she donates to the charity, the $20,000 of shares she donated to charity. But the donation tax, there's also a donation tax credit she receives by donating that $20,000 of shares to charity. And that tax credit is worth over $10,000. So you can see here the $10,000 tax credit almost perfectly eliminates the tax owing on the $80,000 worth of shares that she kept. Okay, so she ends up with, in this case, $79,000 of cash in hand. Now, so the cash in hand after the donation is $79,000. Now, how much cash did Sarah give up due to the donation? She only gave up $7,200 of cash, right? How much does the charity get? The charity gets $20,000 of value, but she only had to give up $7,000 of cash. Remember, she's a little bit worse off than she was if she donated nothing and sold all her shares. But to give up $7,000 to give a charity $20,000 is what I call a charitable arbitrage opportunity. The question becomes then, how do you figure out how much to give to the charity in this example? Well, there is a formula, and it's kind of an ugly formula, but you'll get a copy of this presentation later if you'd like it. The Burlington Foundation can get you a copy. But here's the formula. And in our example here, you plug the numbers in, and it arrives at a $20,000 figure. So if you want to sell $100,000 worth of securities, how much do you have to donate to eliminate all the tax on all the securities? This formula will show you that. In this case, it was $20,000. Okay, I'm just going to wrap this up with a couple of year-end tax ideas, and then I'll pass it back over to Colleen to wind things up a little bit. We'll take some questions. This is not directly related to charitable giving. These are just some year-end tax ideas I thought I'd share with you very quickly. Investors, some ideas for you in particular. First of all, reconsider your asset allocation. If you're earning a lot of interest income, that's highly taxable, of course. But if you earn dividends or capital gains, which are taxed more favorably, that may, if you don't mind taking on a different risk profile in your portfolio, it's a good time to think about your asset allocation going into 2022. Also, reconsider your asset location. Where are you holding your investments? Is it in your registered plans, in your TFSA, in your RSP or RIF? Is it in your personal name? Is it in your corporation? The decision as to where you should hold your money largely is driven by taxes. And depending where you're holding those securities or those investments, you may pay a different amount of tax. So it's time to maybe look at your asset location as well as you head into 2020. Make your interest tax deductible. If you're paying interest costs that are not currently deductible, you could take some investments or cash you have on hand, pay off that debt, and then re-borrow to invest or to replace those investments for that cash. By borrowing for that purpose, you can now make your interest deductible. Think also about deferring capital gains. If you're thinking about selling something before the end of the year, you may want to wait till January before you sell those assets. That will push the capital gains tax liability into 2022. Having said that, we do think that it's quite possible the capital gains inclusion rate could go up in 2022. And if that happens, you'll probably want to sell those investments before the capital gains inclusion rate goes up. We don't know when that might happen. My guess is it may happen, if it happens, in the next federal budget, which will be probably February or March. So by selling your investments in early January, you can push your tax bill off to a future year. And if they do change the inclusion rate in the next budget, you will have sold the investments, triggered the gains at the current inclusion rate. Consider a capital gains reserve. This is the idea of selling an investment or an asset, taking back payment over time so you can pay tax on the capital gain, not in 1 year, but over that period of time, over that number of years that you collect your money. You can spread out that capital gain over a period as long as 5 years. Now, in some cases, you may want to accelerate the reporting of your capital gains. If you believe the capital gains inclusion rate is going to go up, it could make sense to trigger your gains and pay tax sooner than later. But I just thought I mentioned the reserve idea. Donate securities before year end. We talked about that. TFSA withdrawals before year end. If you withdraw money from a TFSA, you can always put it back into the TFSA again later. By pulling money out before year end, you can put it back as soon as January 1st. Okay. If you wait until January to pull your money out, you have to wait till the following year, 2023, before you can put money back in. And give investments to a child. If you have investments that have dropped in value now already, and you want to give some of those assets to a child to help them with a down payment on a home or help them financially otherwise, you can trigger a loss in making that gift to that child. And you can claim that capital loss. Your child will get the investment and can then liquidate it or hold it, continue to hold it. And if it goes back up in value, it's your child, your adult child, I'm talking about adult children here, that will pay the tax on that gain, not you going forward. And then finally, wrapping this up for seniors, some ideas. Maximize RSP or RIF withdrawals if your income is low this year. So if you have very low income in 2021, you might want to take out more withdrawals this year. If you expect your income to be higher next year, you could pay pay less tax this year potentially. Also, if you can still contribute to an RSP, you may want to maximize your earned income by the end of the year. That allows you to put more money into an RSP next year. And especially if you have your own corporation and you can control the amount of your earned income, you may be able to control the level that you can contribute to your RSP. Converting to a RIF before year end may be necessary if you turn 71 in this year. Or you may want to convert some of your RSP to a RIF to pay you out very small, $2,000 annually or $4,000 annually in the case of a couple. And that would allow you to use your pension credit up, which is offsets the first $2,000 of pension income. If you pull $4,000 of income out of a RIF every year and your spouse, and you can split that, which you can do under the pension rules, then you, out of the income splitting rules, you may be able to each claim the pension credit. If you're going to convert to a RIF this year, base your RIF withdrawals in the age of your younger spouse. That allows you to keep money in your RIF for a little longer. Also, if you have to make a withdrawal from your RIF this year, and you've got losing investments in your RIF, you might want to think about taking those out of your RIF in kind, especially if you think that those assets are going to grow in value in the future. Because by pulling that money out in kind, you are meeting your withdrawal requirement. And if you don't need to spend that money today, you can keep that investment in kind in a non-registered account. And as those assets grow in value again in the future, that capital gain will not be taxed inside your RIF. It'll be taxed in your hands personally at capital gains rates. Whereas if those assets go back up in value inside your RIF, you'll be taxed at regular income rates when you pull the money out. Splitting pension benefits. This is what I'm talking about here is an employer pension plan or withdrawals from a RIF or an RSP if you're over 65. Those withdrawals or that taxable pension income can be split with a spouse. You want to think about doing that. And lastly, consider deferring CPP and old age security benefits if you don't need the cash today. By deferring the receipt of your OAS or your CPP benefits to as old as age 70, there's a recent study that was done by some actuaries in Canada that showed that deferring the receipt of that income, if you don't need it today, often results in a much better result. You get more over time by delaying those benefits. But that's a personal decision everybody needs to make. So where have we been? We've looked at some best practices of successful families, talking about wealth differently, 6 types of capital, recognizing the 3 capital realms, making a difference in the world through that insured donation of shares concept or donating securities. And we looked at some other year-end tax planning ideas. So with that, I'm going to stop sharing my screen. And I think, Mark and I are probably more than happy to take any questions that some of you may have.
So we do have some questions, chaps, from the audience. I think we have about 50 folks out there somewhere in the ether. So I'm going to start with the first question. I think probably over to you, Tim, on this one. If you have a donor advised fund, does money used to pay premiums for insurance come from a flow-through account, a direct donation, or from earned income in an endowment?
That's a good question. In this particular case, as long as there are funds inside the foundation to make the payment on the policy, then it doesn't really matter whether it comes from income earned inside the foundation or whether you donate money every year to cover the cost. Most people will donate the insurance, the cost of the insurance premium to their donor advised fund or to the foundation every year, and that usually covers the cost of the premium. That's the most common way to do it.
And Colleen, I just want to add on that. So that's one way to do it. Another way is if the policy is owned by the donor advised fund, some clients will pay directly to the insurance company and it's recorded, and then they'll get a receipt that way. Or we've had situations recently where somebody had donated, a large amount of money to their donor advised fund. The donor advised fund earned 10.1%. It was on a $3 million donor advised fund. So they used $200,000 of that interest on their charity to fund a $9 million joint last to die insurance policy. So they weren't even using the money that was already in there. They were just using the interest. Now, we can't guarantee 10% every year, but certainly it's something that could be adjusted.
Well, 10% every year would be our dream, wouldn't it, Mark? Okay, another quick question from the audience, probably to either one of you. Any comments about a potential increase in the capital gains inclusion rate? Example, 50 to 75%.
Yeah, I'll comment on that first. I think, we've all been concerned about this for quite some time. When you take a look at the percentage you look at capital gains in Canada and who is reporting those gains, the government recognizes that by and large, they are, more affluent, higher income Canadians. And so given this government's tendency to want to tax, more affluent Canadians, I do think this is a very real probability this is going to happen. Now, it wasn't part of the Liberal platform. It was part of the NDP platform to increase the capital gains inclusion rates. So it may partly depend on the kind of pressure the NDP may put on the Liberals to make this change, probably in the next federal budget. If I had to guess on percentages, it's hard to say. I think at this point, it's a 50-50 chance, maybe a little better than 50-50 that we see a change in the inclusion rate. So we're kind of planning for that now.
Now, the good news about that, though, Colleen, is if the taxes do go up, the government has introduced 25 pieces of legislation since 95 to make it easier for Canadians to give to charity. So there'll just be more opportunities for people to use charity to offset those taxes. So that's at least a silver lining in a situation where people are not looking more like a dark cloud. So that's good.
That's exactly right. Yeah.
Great. Okay. Thank you both. Okay. I think we have time for 2 more questions. And here's another one from the audience. Thanking you for a very informative session. This individual understands that very few Canadians donate securities. They believe they heard just 5,000 Canadians gave this way last year, and that this is very surprisingly low. If so, why?
I might, if you don't mind, Tim, if I could just give so I actually heard this from a statistic from the CRA that of the 38 million Canadians and 5 million tax payers who are submitting tax, only 5,000 are using appreciated securities, which to me is a shock beyond shock because, giving cash, checks, and credit cards is the most inefficient way to give. And most Canadians have some mutual funds, some stocks, ETFs, segregated funds that if they've had them for the last 10 or 20 years, they've appreciated. And just to know that 27% of the gains do not belong to you. So you're not as rich as you think you are. So I think it's very important that advisors are talking to their clients about this. Charities are reaching out to their donors and talking about this. And just people who are donating money should realize that there are better ways to give.
Yeah, and I mean, sorry.
So I was going to say, to add to that, I think what happens is people often wait till the very end of the year to give. And, you know, when you give securities, you have to plan ahead a little bit because it's not like you can just do it overnight. Well,
Right.
you probably could, but it takes a little more advanced planning. And I think that's another big problem. If advisors can encourage their clients to think ahead, then this will happen more.
Yeah, and that is very surprisingly low. And I certainly know at the foundation, we are seeing increasingly more donations of securities versus certainly cash and checks. So I don't know where that stat came from, but it certainly does sound very low to me as well. Okay, I think maybe we have time for one more question. Mark, I'm going to ask you this question. My client's RIF contains a large sum of money. Does he have to donate all of it, or can he give just a part of it?
Yeah, so of course it could be any amount, and whatever they give is great because they're turning 54% of tax into charity and saving taxes in their current environment. So yeah, I think what it comes down to is they need to sit down with their professional advisor and do the planning to sort of say, do they have a check mark? They're going to be okay financially during retirement. What's their tax bill now? What's it going to be down the road? Where's that never spend money? What can we afford to give away? And I really liked, Tim, what you gave over with donating those securities, where you're actually no better ahead, no difference, just by donating some of those stocks to charity to offset those taxes. I met with a woman recently, 80 years old, who had $5 million of non-registered securities that she started at $1 million. So there's a $4 million gain. She did very well, but for her to realize over $1 million doesn't belong to her, great way to then take some of that registered money and donate it to charity. And we just move some things around to make it as efficient as possible.
Mm-hmm.
Great. Thank you both. And your questions don't need to stop there, folks. I will be the quarterback. If you want to send me questions to my email address, then I will certainly make sure both Tim and Mark receive them when we get answers over to you. And that's cmulholland@burlingtonfoundation.org. So thank you so much to our speakers for sharing their insights and unique strategies to giving brilliantly today. And a special thank you to Rick and Cheryl Goldring for your very generous gift of life insurance. And thank you to all of you for joining us today. I am very easy to reach by phone or email, so please stay in touch with me. And we hope to see you again at future webinars or, God willing, some in-person events down the road. So I hope you enjoyed the session. I hope you have some key takeaways that you can ponder, as Mark says, very quickly. So everything is still fresh in your mind and you're able to provide your clients with greater detailed information and you're able to all give brilliantly to charities that are in great need. So enjoy the rest of your day, everyone. And again, thank you for joining us.